Hello, folks. It is Wednesday, June 14. It's about 10 o'clock in the morning on the East Coast of the United States. Just a quick update on the precious metals. Let's look at the current market drivers as I see them. Of course, we resolved the debt ceiling farce. They actually suspended the debt ceiling until at least January of 2025. That means they get to spend as much money as they want for the next 18, 19 months. Today, we've got the FOMC meeting. We'll find out this afternoon whether we're on pause or we're going to get another rate hike, another quarter point hike. We'll look at a couple of the debt market charts. And based on the charts, if we were betting based on the charts, we'd expect another increase today, not a pause. But, you know, the talking heads can do whatever they want. Obviously, we've got a rally going on in the equity markets. We're back to risk-on mode, fear of missing out. Hot money has come out of the precious metals and into the equity markets. We'll look at a few charts of the equity markets. We're in the seasonally weak period for the precious metals, June and July. As we head back into August, September, we'll get some strength back in seasonally, precious metals. And of course, we can get spikes, strength in the precious metals based on events. One of those is happening starting today. That's the St. Petersburg Economic Summit. They're going to be talking about de-dollarization, path forward with the BRICS, etc. Expectation that there are about 140 countries meeting in Russia today and over the next couple of days. Then we've got a BRICS summit coming August 22nd. James Rickards is saying that he believes this is when the BRICS organization will announce their new reserve currency, and that the international settlement aspect of that currency will be gold backed. But then there will be a separate currency for day-to-day, you and I to go buy bread, etc. at the grocery store. So anyway, potential for any kind of economic news coming out of those two events. Of course, we've still got the conflict in Ukraine going on. Surprises there might affect the economic markets. Just wanted to take a quick look at, this is gold in the Turkish lira. And of course, the Turkish lira is just, this is a fiat currency that is in the process of dying and has been, there was 2008, 2009, and just a steady decline. That decline has accelerated just in the last, what do we look at? This is weekly chart. So just in the last few weeks, this decline has accelerated. As a fiat currency dies, this is what gold, or what we can expect gold to do when it is priced in that currency. Because keep in mind, gold is the only real money on planet Earth. All these fiat currencies are bullshit. And so the Turkish lira, I believe this will be the first of the Western fiat currencies to just out and out die. And of course, Turkey is likely a member, or will be a member, of all of the, BRICS, SCO, all of the non-Western economic alliances. Turkey is likely to play a part in, be a member of, which of course is interesting because right now Turkey is still a NATO country. Turkey plays an interesting role in geopolitics. So anyway, we can see this is what I expect gold to do when a fiat currency dies. Now, it may look different as the U.S. dollar continues its path towards, ultimate death, because for now, the U.S. dollar is the world's reserve currency. And so gold is probably going to look different as the U.S. dollar continues its death. and of course the U.S. dollar's role as the world's reserve currency may be replaced, displaced very shortly, actually this summer. Whether it's the St. Petersburg summit or the BRICS summit, either one of those events could quickly displace the U.S. dollar's role as the world's reserve currency. This is the seasonality chart for gold. This is from our friend Bob Moriarty, 321 Gold. We can see here that June and July, these are the seasonally the weakest months for gold, and of course silver follows gold. So, and then we can see as we head into August, September, into the fall, that's our strongest gaining season, strongest season for gains in the precious metals, and keep in mind that this year's rally in the autumn fall could be spectacular in the precious metals given the other events, the BRICS, St. Petersburg, those two summits, surprises in the Ukraine conflict. We could see a very dynamic, very exciting fall in the precious metals. And of course, I'm a gold bull. Obviously, I'm biased to higher prices in the precious metals, so always keep that in mind. Now let's jump into the charts. Gold in the monthly time frame. So I was hoping that we would push on up through this resistance, the top of this pennant pattern, where this is the flag. These two horizontal dashed lines mark the top and the bottom of this pennant, the flag on our flagpole. But obviously, we set a new high and then pulled back, and currently gold is just, flirting with that level as resistance currently. But notice that MACD is on a buy signal in bull mode, suggesting that the primary trend remains up. Energy is high. So, gold is looking good in the big picture. And in particular, if we consider that we're in the seasonally weak period of the year, yet gold's holding on quite strong at the top of this range. It's not it's not pooping out and heading lower. In the weekly time frame, so gold is finding support along this horizontal level, which formed by this prior peak. Just kind of sideways action, bumping along that level, finding resistance at the 10-week moving average. Overbought based on MACD. We can see there was the prior level of overboughtness in MACD that turned prices lower, and here we are again. We're at that level, got a little bit above, but basically at that level of overboughtness that stopped gold back here. Energy's about mid-range, still on a buy signal based on the moving average. That's the golden cross. Well, I guess actually the golden cross is typically talked about in the daily time frames, 50, 200 moving at 50-day and 200-day moving averages. These are the comparable in the weekly chart, 10-week, 40-week, same thing. And so here we are. This is the 50 and the 200 golden cross. So still on a buy signal. MACD has dropped down into bear mode, sideways action. I wouldn't look for buy or sell signals based on MACD. But notice that MACD is much closer to being oversold than overbought. So lots of upside potential in momentum. Energy mid-range. Price here in the daily time frame, is running into resistance at the 20-day moving average and the median line of this Andrews pitchfork. So just for several trading weeks now, I guess that's probably 3 trading weeks, been bumping its head up against that resistance and unable to push higher. So that's gold. Silver, similar story, looking pretty good in the monthly time frame, still in bull mode, still on a buy signal, energy very elevated. So long-term silver looked good. Weekly time frame, support along the median line of this modified shift pitchfork, resistance overhead at the 10-week moving average. We've got a horizontal support resistance level, more resistance than support. Notice it didn't hold as support. Price plunged below that level, but appears to be finding resistance there. So overbought or very close to being overbought in MACD. Energy is elevated. So here in the weekly time frame, silver's still looking good. Same thing I said about gold. Seasonally weak period, and yet silver's not falling apart. It's not heading higher, but it ain't falling apart either. So daily time frame, overhead resistance at this horizontal support resistance level, only again, just a little bit of support right there. The rest of it has been resistance. Playing with support and resistance along the median line of this modified shift pitchfork. MACD is in bear mode on a buy signal, about halfway between overbought and oversold based on MACD. Energy is elevated. So that's in the daily. That was silver. Mining stocks, same thing. Long term looking good. Apparently in a bull market, although it's kind of a stealthy bull market. It's not shooting off skywards quickly, but that's a good thing. Those skyward moonshots aren't sustainable, whereas a steady uptrend like this is sustainable. If you want a just simple trend line, that's what the mining stocks are doing based on this ETF, which it's the junior miner ETF. MACD on a buy signal, energy above mid-range. Weekly time frame, support along the 40-week moving average, this horizontal support resistance level, MACD in bull mode. Daily, bumping sideways, playing with support. We've got the 200-day moving average, this horizontal support resistance zone, lower median line of this modified shift pitchfork. MACD is closer to being oversold than to overbought. Energy mid-range. So mining stocks, they're going to follow the metals. But again, the key thing I would note on the mining stocks is that they aren't falling apart. So they're just kind of hanging in there. This is the dollar in a monthly time frame. Dollar reached a very overbought level, both based on price and on MACD, and has been pulling back from that level for several months now. Half the year, but still in bull mode, suggesting that the primary trend in the dollar is upwards, and as the reserve currency, that's reasonable to expect. Energy is very low in this time frame. Weekly, testing support on the 10-week moving average and the upper median line of this shift pitchfork. Bear mode in MACD, energy above mid-range. Let's look at the daily chart. So in the daily time frame, obviously the dollar kind of fell apart. This is overnight, and today's action found resistance at the upper median line extension of this modified shift pitchfork, bumping its head, for the last couple of trading weeks, 3 trading weeks, and then fell apart overnight. Looks like today it's testing support on the 50-day moving average. Again, overbought in MACD, based on MACD, overbought on a sell signal based on MACD. Energy is very low. So nothing here in this chart suggests strength in the U.S. dollar. Depending on what the Federal Reserve, FOMC, what they say this afternoon, what Jay Powell has to say, that could affect all of these markets. But we'll know we'll know this afternoon. So this is what I was saying a few minutes ago. Based on these charts of the debt instruments, if I were placing a bet, I'd be betting on higher rates. I would not be betting on a pause or lower rates. This looks like an instrument headed higher. Energy is elevated. We're on a buy signal in MACD, and MACD's in bull mode. Price is broken up above this horizontal. It was resistance, now appears to be acting as support. So that looks like a chart that wants to go higher. Now here in the 2-year, we're pushing up into this resistance zone, and so far have not been able to push very far into it. But again, MACD in bull mode on a buy signal, energy very elevated. And so this chart looks like an instrument headed higher rather than lower. Now, some people, they might point out that this is kind of a megaphone pattern, which is not really a positive thing necessarily. So that's potential negative in that chart. 5 years, this is the weekly time frame. Again, found support along the 40-week moving average, appears to be pushing higher. MACD in bull mode on a buy signal, energy very elevated. That looks like a chart that wants to go higher. Yield in the 10-year weekly time frame, same thing, support on the 40-week moving average, resistance overhead. This is the upper median line of this modified shift pitchfork. Bull mode in MACD on a buy signal, energy very elevated. So again, all of these interest rate vehicles look like they want to head higher. Now we're up at the long end of the curve, 30 years. Support on both the 10 and 40-week moving averages, MACD in bull mode, energy very elevated. Now let's talk about equities. Again, we've got a rally going on in the equity markets. Well, a selective rally. I'll do a separate update on the equity markets because there's enough going on there to talk about. But so here in the S&P 500, we're pushing up into this overbought level in MACD. Still got a little ways to go, but not much. So wouldn't expect much more out of this rally in the S&P 500. Energy is very elevated. The market, the overall equity markets have been very narrow in breadth. There were only about 7 stocks driving it higher. NVIDIA being one of them, obviously that was a momentum stock. But the Dow wasn't really participating. It's, just kind of sideways action for months now, and continues that way. And so again, very narrow market moving higher. What happened in the last few weeks was the tech stocks. So the tech stocks were moving higher while the broader equity markets basically bumped sideways. And we can see that here, NASDAQ, the tech stocks. But again, running into overbought level in MACD. Energy remains elevated. The stocks can move higher if they want to. A lot of the drivers in the equity markets, I believe, are it's the fear of missing out. So hot money moving into the stocks because they don't want to miss out on this rally. And of course, the expectation that the Fed is going to pause. If you did a poll of Wall Street, at least what they're saying publicly, they may be telling their clients, their large clients, something different. But publicly, they're expecting a pause from the Fed today. This is the NVIDIA. This stock is being driven higher based on artificial intelligence and yeah, I'm not going to go there. And people's expectation for what AI will do or potentially do for everything going forward. I don't share their expectations, but that's just me. Tesla is another stock driving the markets higher. And of course, you look at stocks like this in the indexes that are weighted, these stocks get weighted higher. And so not only are they moving higher on their own, they're pushing the indexes higher because they've got a higher weight in the index. Tesla's another one of those stocks, but we can see again, overbought. Now we're looking, this is daily time frame. Notice that we've got this open gap here. My expectation is that Tesla's going to fill that open gap, and I'd be very leery of what it does after that point. It wouldn't surprise me at all to see Tesla roll over at that point once it fills that gap. Obviously, investors are accumulating shares based on the accumulation distribution indicator. MACD is very overbought, still on a buy signal. Energy is elevated. So again, yes, we have a rally in the equity markets. It's a very narrow market. Oh, another thing. So they pushed those 7 stocks that were driving the broad market higher, the index is higher. So 7 stocks. And those stocks, they weren't able to push any higher, so they rolled over. And when I'm using they in this context, I'm referring to Wall Street and the whales, the big pools of money that are able to push the market around basically in any direction they want for short periods of time. And so they pushed those 7 stocks as high as they could, and then they shifted over to the small cap stocks. And so if we look at an index like the Russell 2000, it's moving higher because that's where the hot money is right now. It's in those small cap stocks. So that's all I've got for this update. I'm not concerned about gold. The next 2 months might not be much fun. Hopefully we just get more sideways bumping and not a big decline. We've got a couple of potential catalysts, basically the non-Western world, what they decide to do with reserve currencies. And so I'm going to leave it there. I will talk to you soon, folks. Have a great day.